Welcome back to Bakir Capital, a channel where we don't chase headlines, we uncover the financial stories hiding beneath them. Today, I want to show you something that most investors never see until it's too late. Right now, millions of people around the world are focused on stock prices, AI companies, cryptocurrency rallies, and the next big investment opportunity. Social media is filled with screenshots of profits, market predictions, and promises of easy wealth. But while everyone is looking up at the bright lights of the financial markets, something much darker is happening underneath the surface. A silent shift. A shift that could affect businesses, investors, homeowners, and even ordinary people who have never bought a single stock in their lives. And the strange part is that most people don't even realize it's happening. Because unlike a stock market crash, this problem doesn't arrive with flashing warning signs. It starts quietly. It starts with debt. Now, debt itself isn't always bad. In fact, debt is one of the most powerful financial tools ever created. Governments use debt to build countries. Companies use debt to expand operations. Entrepreneurs use debt to launch businesses. Even families use debt to buy homes and improve their future. Debt can create opportunity. But there's one important condition. Debt only works when the cost of borrowing remains manageable. And that's exactly where today's problem begins. Imagine a business owner who borrowed millions of dollars during a period when interest rates were incredibly low. At the time, everything looked perfect. The monthly payments were affordable. Revenue was growing. Investors were optimistic. Banks were eager to lend money. The future looked bright. But then something changed. Inflation arrived. Central banks around the world started fighting inflation by increasing interest rates. And suddenly, the cost of money began rising faster than many businesses expected. What once felt like a manageable loan slowly became a financial burden. A company that was paying millions in interest suddenly found itself paying significantly more, not because it borrowed additional money, but because the cost of that existing debt became more expensive. Now multiply this story thousands of times across entire industries, and you begin to understand why some of the smartest investors in the world are paying close attention. Because the real danger isn't always visible on the surface. It's hidden inside balance sheets. It's hidden inside financial statements. It's hidden inside debts that many companies took on when money was practically free. For more than a decade, businesses operated in an environment where borrowing costs remained historically low. Cheap money became normal. Companies expanded aggressively. Private investment firms completed massive acquisitions. Investors searched for higher returns by taking greater risks. Everyone became accustomed to the idea that low rates would continue forever. But financial history teaches us an important lesson. Nothing lasts forever. And when conditions change, weaknesses that were invisible during good times suddenly become impossible to ignore. Think of a ship crossing the ocean. When the sea is calm, even a damaged ship can appear perfectly fine. Passengers enjoy the journey. The crew remains relaxed. Everything seems under control. But when the storm arrives, hidden weaknesses begin to reveal themselves. Cracks appear. Water enters. Problems that existed all along finally become visible. The global financial system works the same way. During years of easy money, many risks remained hidden. Now that money is expensive again, those risks are slowly coming into view. And that's why some analysts believe we are entering one of the most important financial transitions of the decade. Not because a crash is guaranteed, not because disaster is inevitable, but because the rules of the game have changed. Companies that thrive during low interest rate environments must now adapt to a completely different reality. Investors who became comfortable with easy gains must now learn how to navigate a more challenging market. And governments carrying enormous amounts of debt must confront difficult decisions about spending, borrowing, and economic growth. The world is entering a period where money once again has a price. And that price matters a lot. Welcome to the new era of finance, an era where financial discipline matters more than ever, an era where strong balance sheets become valuable, an era where smart investors focus less on hype and more on fundamentals. Because at the end of the day, markets can ignore reality for a while. Investors can ignore reality for a while. Politicians can ignore reality for a while. But mathematics never ignores reality. Eventually, every debt must be serviced. Every interest payment must be made. And every financial decision carries consequences. The question isn't whether those consequences exist. The question is, who will feel them first? And that's exactly what we're about to uncover. So grab your coffee, sit back, and join us here on Bakir Capital as we dive deeper into one of the most important financial stories unfolding right now. But to truly understand where this story is heading, we need to look beyond the headlines and focus on something most people never pay attention to: cash flow. Because in business, revenue gets attention, profits get headlines, but cash flow determines survival. A company can look successful on paper while quietly running out of money behind the scenes. And that's exactly what happens when borrowing costs rise faster than a company's ability to grow. Imagine running a business that borrowed $500 million during a period of cheap money. For years, everything works smoothly. The company expands. New employees are hired. Marketing budgets increase. Investors celebrate. Management earns bonuses. Everyone feels like a genius. Then, interest rates rise. Suddenly, millions of dollars that were once being invested into growth are now being redirected toward debt payments. Expansion slows. Hiring freezes. Projects get canceled. Margins shrink. And eventually, executives are forced to make difficult decisions. This is where the hidden pressure begins. Because financial stress rarely appears overnight. It builds gradually, quarter after quarter, year after year, until eventually the pressure becomes impossible to ignore. And here's what makes the situation even more fascinating. Many companies today aren't just dealing with expensive debt. They're dealing with debt that must be refinanced. Think about that for a moment. Millions and even billions of dollars borrowed years ago are approaching maturity dates. Those loans cannot simply disappear. They must either be repaid or replaced with new debt. And that's where reality starts hitting hard. Because replacing a loan taken at 2% with a new loan at 7% completely changes the financial equation. The same company, the same business, the same customers, but a dramatically different cost structure. This is why many financial experts are watching what they call the refinancing wall, a massive wave of debt coming due over the next several years. And when that wave arrives, many companies will face a difficult choice: pay significantly higher interest expenses, raise new capital from investors, sell assets, cut costs, or in extreme cases, restructure their debt entirely. Now here's the interesting part. The stock market doesn't always react immediately to these risks. In fact, markets often remain optimistic long after problems begin developing beneath the surface. Why? Because investors are emotional. Human beings naturally focus on what is happening today rather than what might happen tomorrow. When markets are rising,